All right. Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the Last Week in Mortgage Today, our weekly walk through all the latest news developments with the mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host. This week, the EVP over residential lending for West Banco, Ed Hensley. Ed, great to see you.
Rich, thanks for having me. Good to see you too. And there's nice surroundings that you're in.
Yeah, and I apologize. I may have to move to somewhere with less background noise, but I think I could not show off this background. We're out this week, TMC, at our hosting some collaboration labs in beautiful Sonoma, California, wine country, at the Fairmont Mission Inn in Sonoma. So stepping away from a lab group I've been moderating for our weekly discussion. So let's go ahead and get into it. So Ed, let's start with just the rate climate continues to dominate the narrative, seeing the biggest run up. Rates have been moving up obviously all year, but saw the biggest 1 week increase in mortgage rates since 1987 to the highest levels since 1987, all off the hotter than expected CPI number. The Fed meeting next week. Seems like the Fed caught off guard by inflation. Now some really reactionary, more aggressive than expected moves. Seems almost now like they're trying to almost break the economy to, kind of help stem the inflation issues that are plaguing it in a lot of ways. And but it's taking rates up with it, and our industry obviously being affected. So.
Yeah, Rich, I mean, I lived through the 87 meltdown, if you want to call it that, if you remember that October day, if you were in the business back then. Some similar signs, but yet different. And what I would tell people is then in 88, mortgage lenders had a good year. The market has to find its footing. That's what I'm telling our sales staff. It will find its footing. It's going to be very difficult to find footing when you've got 8% plus inflation numbers. So to your point, the Fed's trying to play catch up. They admitted they made some mistakes along the way. There's a lot of moving parts with the price of gas to everything else. And I think it's going to take a little time for to read the tea leaves, as the saying goes. But we will find a footing. We will find a way. There's still demand out there, and maybe not as strong as it was. I know you'll probably touch on that here in just a second. But there are positives that we just have to focus on. We can only control certain things.
Yeah, and that's I think I'm a glass half full guy. Hasn't been a ton of great, super exciting news these last 6 months to talk about on this show. But so one thing I've kept kind of harkening back to is this underlying demand from Americans to buy houses. Existing home sales report just came out a few hours ago for May. It was down 3.4% versus April, but better than projected by economists of note inside that number. The median average sales price up 15% from a year ago at this time. The average median sales price in May, $407,600. But so yeah, another report this morning on home sales that was not overly rosy, but a little bit better than those economists were projecting. And I think speaks to your point about there being a lot of demand in the marketplace to purchase homes.
I think one thing to kind of keep in mind and taking the pulse of the different markets that we're in, the market's definitely changed for the listing agents. And maybe 60 days ago, they were listing the house for what they thought was more than it was worth, but still driving up that demand and getting way over a list. And maybe getting 10, 15, 20 over offers. And that's changed. So a lot of their strategies are, hey, we're going to list it more realistically. And they may not get 10 offers or 5 offers, but they're still getting 1 or 2 if they price it right. So I think, again, the market's shifting. It's got to find its footing. There's still houses selling. And we, even though the inventory is up slightly, if you looked at the numbers, the listings have trended slightly up. We're still not at what would be considered a normal healthy supply. New constructions carried a lot of the burden. Talked to a couple builders the other day, said, hey, good news is your lumber's down, like 52% from the high this year. And they're like, true, but if it's anything petroleum based, it's increasing on the other side. But overall, they think their costs are leveling out, the declining. That should help some. There are positives, as you said, Rich, with some not so positive. So we just have to kind of keep an eye on that.
Yeah, absolutely. And, just being here in the labs and talking to business owners, not helping matters right now is just like the secondary market for products, right? You got 30-year fixed rates that are in the sixes now. And to your point, people still want to buy homes, and you got 30-year fixed rates that high. It brings a lot of other products into the mix. The secondary market, though, soft for all of it for just a lot of reasons, right? Treasury yields are up. If you're an institutional investor or managing a hedge fund or managing money, you can buy 10-year treasuries right now at zero risk, absolutely whatsoever, at 3.4, whatever it is right now, 5-year money, even in that same level. So it's mitigating a little bit what investors will buy for mortgage-backed securities, which carry a little bit higher yield, but some risk with it. I'm moderating this today, a group of IMBs here at our lab, and they're all lamenting there's no ARM product. There's no secondary market for ARMs. Banks like WesBanco, you can kind of go get what you want right now because whatever you offer on the street to your salespeople is going to be viable to buyers, and it's going to be better than what the secondary market's offering.
Rich, I made two comments on your point. Your point's well taken. Number one, and I kept saying this to people 6 months ago, when the Fed started tapering off, they weren't going to keep pumping money in and buying securities. It was going to create a little bit of a supply demand issue, right? I think we've seen that. As you said, the demand's just not there. Plus the fact they're not reinvesting those dividends. I mean, they're tapering slowly, but it is happening. And I think from the ARM standpoint, you're right. There's not really a viable secondary market. It's kind of all over the board. It's more private label. And if you're a bank and you want to originate portfolio product, there's ample demand for it. We like a balance between saleable and portfolio. And the example I will use is once the rates started getting to 5, we saw people saying, well, you know what, I don't need that 30-year. What's your ARM rates? And they started, chasing, I call it chasing the yield down. We offer a 15, a 10, a 7, a 5, et cetera. So they started with the 10 to 15 year, and they slowly slid down to the 7 and 5s because of rate. I call it chasing the yield, because now all of a sudden they're thinking, well, if rates come back, I will refinance. I saw an originator who used to work for me post a thing the other day, says, buy the house, rent the rate. Her view was, you can always refinance if rates come down, but if you're paying rent to a landlord, you're not paying principal down, you're not building equity. Don't worry about the rate if you can afford it type deal. I thought it was a very interesting saying. I'm sure we could debate that a little bit, but that was how the market's shifting, how realtors are going to have to shift how they market, and how LOs are going to shift how they have to market. The low-hanging fruit's gone. We're back into the selling game. We're back in, we've always been in the service game, but we have to act a little bit differently than we did during the pandemic. It's a relationship business. It's education business. There's a lot of moving parts at this point.
It's a great line. I'm totally reusing that. Buy the house, rent the rate. I like that because yeah, I like that. It makes a lot of sense because it's one of the other topics of discussion today, just with the lab group I was at, is you're not doing gobs of volume right now, but purchase business is consistent. You're creating a book now of people that have bought homes either on non-conventional products or higher fixed rate products. The Fed is indeed successful in breaking the economy, stemming inflation. A lot of people feel like a recession could be part of that. Those types of climates be more likely than not that we'd have a lower fixed rate market and some refinance opportunities for people. And one of the other equity, just in general, $27.8 trillion in collective equity in their homes from Americans. Another topic of contention, IMB Lab Group, right? A lot of existing or past clients and that have done 30-year fixed rates in the 2s, maybe the 3s, that obviously don't want to touch those rates. You guys been doing some stuff on the home equity side at WesBanco. It's been another topic of discussion for sure today.
Yeah, I think, Rich, to that point. So last couple of years, we've seen some runoff on that HELOC balances because people were fixing the rate. To your point, hey, I'm in the 2s, I'm in the 3s, I'm gonna lock this up. But as that's risen, that equity is a very valuable asset. People want to tap that asset. So yes, we've seen the HELOC demand increase slightly. We anticipate that going higher. I won't name the name, but a very large financial institution that said 2 years ago, hey, we don't want to be in the HELOC business. We don't want line of credit. I said, you know what? We think we're going back in, with where we're at now in the rate cycle and everything else. So I think that's going to be a hot product moving forward. People traditionally need cash for various reasons, whether it's to remodel, pay off debt, life's emergencies or whatever. And I think, there's people trying to create a secondary market for that. And I think it's going to be interesting to see how that shakes out with some of the fintechs and some of the private investors and things like that. I don't think banks will necessarily have a lock on that business like we have in the past.
Because I worked for banks in the past, and you have, man, most of your career, some really successful banks in the mortgage business, and you can only put so much stuff on the books. I think like the IMBs here at this, the banks, like between the interest rate risk, the liquidity risk, just tying assets up. You can only do so much of it. You have to reserve money against it, and that's money you could lend out or do other things with. So not quite as cut and dry as the banks are just going to do all the HELOCs and all the ARMs, right?
Right. I mean, Rich, if again, look at the last couple of years after the pandemic, banks had more cash deposits than they've ever had. Money was flowing, people were putting it in the bank. We were cash rich along with our competitors. And then if you're a stock company and you're driving that stock price, it's all about loan growth and what you're doing. So, like I'll use us as, Westbanco as an example. Last year, we get the call, hey, we got the portfolio running off. We need loan growth, but hey, we still want you to do that secondary marketing thing too. We want to straddle that line, which we did. But as the rate curve changes, what you just said before, the percentage of people wanting ARMs versus fixed is much higher. And even though you want loan growth and you're putting them on at current rates, how much capital do you want to tie up in an instrument that's, even though it's an ARM and it may have a 3, 5, 7, 10-year ARM type capability? How much of that do you want to tie up on the books as far as capital goes? And all the things from a regulatory standpoint of servicing and everything else. So it is a very fine line that we walk. As a bank, we want both. We like mortgage product; it's performed very well, but you can't, you can, but I'm not so sure it'd be the wise thing to do. You could do all the ARMs you want, but again, you want that balance. You just can't carte blanche say we're never going to run out of money. There are a lot of banks, even though they had deposits, that got them caught up. There are some banks that are still borrowing money to loan money if they're lent up, depending on what their deposit to loan rate is. I know there's some people that are 90%, 95%. We're not. We've got cash, but that's another competitive thing that you have. And I think on the banking side, that's going to be a driver on what you see happen here, 6 months, 12 months down the road, as people can't grow that loan balance, or they can't grow the bank, or they don't know what to do with those deposits, or they don't have deposits in some cases. So that's kind of the dynamic we face on the financial institution side. A little bit different on the IMB side. They've got to find the partners they can sell to, et cetera. So challenging times, but this is what we do.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by the EVP over residential lending at Westbanco, Ed Hensley. And Ed, you go back 10, 15 years to the mortgage meltdown and the years that followed it. Banks, depositories in America were doing low 70% market share of mortgage product. And because of the meltdown, you saw a lot of the big banks kind of, take their feet out of the water of certain pools, and fast forward to today, led by the Rockets of the world. IMB is now doing about probably 72% of all mortgages in America. Feels like that's starting to swing kind of back to the middle. Just talking to bank members like yourself, you're in a good spot right now, right? It's like, this is a good, there's times where it's tougher to be a mortgage banker as a bank, maybe a move as quick, certain things, marketing wise, but this type of climate, you're a division of a larger unit. You can withstand the lows. You have the ability to lend into the portfolio, not unlimited, but, you can use that gunpowder, right? You can, like you said, you can only do so much in the portfolio, but you can strategically use it to bring on board those good customers that might bring on deposit some money with you, or go into some other bank products.
Yeah, Rich, there was an article that came out toward the end of last week. I'm not sure if it was in Mortgage News or if it was in Housing Wire, one of the two, that the non-banks had the lion's share of purchase money last year, first quarter. And I think there's that perception out there with a lot of realtors that they move faster than some banks, especially the bigger banks. And I think that's going to be something that you're going to see financial institutions try to smooth that out as we get into this market. You mentioned some good companies, and mortgage companies traditionally can make decisions and move quicker than we can as a financial institution because of regulation, audits. I tell people that any given month, I probably have 10 to 12 audits per month It doesn't, it doesn't matter what you get, your internal, you get your FDIC, we get the CFPB. We've always got somebody. And I think if you're not in a financial, you may only have half those or a third of those, and it does affect how quick you can make decisions. And again, we're in a good spot. I think IMBs are in a good spot. You just have to pick your business model, kind of say, hey, this is where we're going, this is what we're going to do, and stick to that business plan. So it's all going to work out.
And our good friend and fellow Ohioan and IMB owner Teresa Rose, her own spinoff in the comments of the chat, marry the house, date the rate. I like that one too. So thank you for that one, Teresa. And we got Teresa as a co-host of this show coming up here in a few weeks. So as always, any comments, questions, pump them in the chat of the Q&A and we'll incorporate them into the show. Ed, the regulatory climate right now also evolving pretty quickly. It's been a wild couple of years for our industry, man. It's really the pandemic fueled business, the change of climate now, the rates, and just everything changing with the change in presidential administrations. Seeing the CFPB, which was really just a shadow kind of organization under Trump, to be honest, now is, really starting to get after it. Make some headlines for things they're doing and saying. And I saw a news release a couple days ago where the American Bankers Association and Independent Community Bankers, so two of the bigger banking groups, kind of jointly made some comments to the CFPB, like, really, you guys, like, if we want our members, our banks want to acquire other banks, I don't know if that's necessarily something CFPB should be involved in, but they are. I cannot tell you how many times I've heard CFPB Director Rohit Chopra use the term formerly little used provision. He's finding a lot of the loopholes in current legislation to get into the closets of some people.
It's amazing, Rich. We saw that same articles in the Wall Street of little known loopholes, for lack of a better term, little known regs. It's not just banks. It's not just mortgage companies. It's seeping into the credit reporting bureaus and anything that's consumer related. There's a proposal out there for feedback right now on, quote, lender junk fees, and what does that mean? And is that fair to the consumer? I think that's one of the biggest things that's hanging out there, because that will affect everybody. We all have costs. We have costs from technology, we have costs from people, we have costs from just doing business. And right now they think that should be more transparent in the rate versus cost. I'm very, very intrigued as to where that's going to go. And does that then bleed into the title company side of the business? Does that bleed into the realtor side of the business? Because everybody charges fees on a transaction right now. And I think as an industry, that's something we really have to kind of keep an eye on. I think it's a big issue that's brewing. But it is to your point, the CFPB is a very aggressive agency right now. It's not like it was in the Trump years where it's, hey, do your business and move on. It's like, we're going to look over your shoulder, we're going to regulate you, and we want to be involved in everything.
It's a slippery slope because, to your point earlier, like, almost anything can be viewed as consumer facing. Like, is a bank merger a consumer issue? I think the CFPB's issue in the column I read is, well, we got to take a look at lending footprints and fair lending combined, all that stuff. So it's, it is a slippery slope in that. And then at the MBA secondary conference, when Chopra was speaking, he made a comment about essentially being able to regulate like any IMB in America because of little used provisions in Dodd-Frank. So really have expanded, at least rhetorically, the scope of things that at least they're on record as saying they're going to be taking a look at. And, hard not to think, I mean, I was just having this discussion with somebody this morning, got midterm elections coming up here, and then we're going to be in a presidential election cycle. And our industry, I can't think of many others that are as affected as much by who's in the White House as our industry, right? It's a swinging pendulum, and we've seen the extremes of that with the last couple administrations. Yeah,
Rich, I mean, you're looking at everything from IMBs being subject to CRA lending, right? That's been, a hot topic with a lot of the IMBs. Banks have dealt with that for years. Take it a step further, how can we expand, loans to the disenfranchised, and what are we going to do to help people? So there are a lot of moving parts. I think you saw what Fannie and Freddie did last week with their announcement to help with certain programs. saw probably one of the most negative opinions in the Wall Street I've ever seen based on that ruling. So everybody's got an opinion, and again, we all want to make loans. We all want to do the right thing for people, but we just have to make sure that we're all on the same page. And you can't get in the bad side of the regulators, that's for sure.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, broadcasting live from our collaboration labs at the Fairmont Mission Inn, beautiful Sonoma, California, wine country, and joined this week by Wes Banco's Executive Vice President over Residential Lending, Ed Hensley. Ed, a lot of talk as well with just the attendees here. Just about the competitive climate. Everybody's obviously recruiting very aggressively right now, and it's really recruiting and cost cutting, and just really extreme focuses on each, and time to look at the attempt to really, for leaders like yourselves to, as opposed to the pandemic years, right? You are just really deflecting business and throughput and getting loans closed, but leaders like yourself much more focused on kind of hands in the cookie jar type stuff this year.
Yeah, Rich, it's less business, and making sure you got the right staff in the right spot, how efficient you are. And one of the measurements banks use overall is the efficiency ratio. It's not just mortgages for the entire bank. And I think you're gonna see people shift what they're doing and how they're doing it, how they're using technology, what technology they're using versus people. We've all seen the headlines of who's let people go. No one wants to hear that. Unfortunately, I don't think we're done hearing that for a while as we go down the cycle here. But again, if we go back in history, you and I have been doing this for a while, we've seen this before. We brought a lot of new people in the last couple of years. We will right size it. We will find homes for those people. It'll all work itself out. But it is a changing market. Definitely changing.
Definitely a changing market for sure. And a lot of other discussion here this week, just about marketing efforts as well. I think that we've heard from a lot of our members this week, if it's different marketing strategies or rebranding or ways that you're marketing to referral partners. It's right now, there's not a lot of business out there to be had. There's still a lot of realtors. So there's just like a hand-to-hand combat level. Realtors are being inundated with lenders that want the small amount of business they're able to do. Lenders really working hard to do things to differentiate themselves from their competitors right now. Another broad theme we're hearing and seeing.
And Rich, I think to that point too, real estate companies are going through their own transformation. They brought a lot of new agents in the last couple of years, a lot of online agents, a lot of different selling methods, for lack of a better term. And we saw some fallout from that last week with a couple of the big companies. So I think they're looking at themselves in the mirror, and it gets back to what we said: meeting people. I call it what's old is new again, right? Relationships, how you get business. The days of a realtor just putting the sign in the yard and having 20 offers the same day, no, that's gone for a while. So they're going to have to learn to be different. Our LOs are going to learn to have to be different, and it'll balance itself out.
Absolutely. What else are you hearing and seeing out there in the marketplace? We were talking about construction. It's going to be a much bigger part of the market for sure. Again, an area where independent mortgage banks really, it's just inherently a difficult product for them to do on a lot of different levels. To your point, like with the HELOCs and some other things, there's people that are trying to establish a more easy and liquid secondary market for products like that. There's reasons that secondary markets for those products have not existed in the past, but anytime you get one of these cycles where it gets really slow and you got more of this product, people are trying to figure it out. But construction's it's a difficult, it's a difficult product to do, right? I mean, you're approving a borrower, and then you're dispersing loans to build a home that has just a myriad of different checks, and it's just a long, there's a lot of interest rate risk to it, no matter how you do it.
Yeah, not everybody can do construction lending, but it's become a big part of our business. Always has been, but more in the last couple of years, along with the rehab part, when people couldn't find exactly what they look, they'd buy and do a rehab. Talking to the builders, if you talk to the high-end builders, they'll tell you, yeah, we've slowed down a little bit, but that's okay. It's not, it's not where we're panicked. If you talk to, the track builders, they've definitely slowed down a little bit. Some of them are actually offering incentives again. I saw that this weekend. The realtors will tell you that the changing market's been the resale. Again, I think we go back to what we talked about. People were pushing those sales prices. As you talked about the cost, how much it is a year-over-year increase. I think you're going to see that back down over the next 90 to 180 days. But I think new construction is still going to be a strong part of our business model.
Yep. And the Biden housing supply plan, last Friday on the Rundown, the show I did with Chrisman, we had on Jim Parrott, who's with the Urban Institute. And he was basically Obama's top housing advisor for most of Obama's term. It was really, really interesting to get his perspective. And, essentially what he was saying is that, you're going to see the GSEs he said that their focus is the presidential administration completely on things they can do to help the supply side of the business, which was encouraging because obviously that's what kind of ails housing in America. But, the real world ability to impact supply, it's just long. It takes a long time, no matter what, like he said, there's a whole playbook to help demand if it's down payment assistance, but the playbook on helping supply issues is much more inherently difficult and much longer and takes a long commitment to execute. I don't know if you had a chance to look through some of the stuff that the Biden administration put out on supply, if you had any thoughts on any of that.
Well, you have a two-pronged approach here. You have a supply issue, which everybody's trying to get the supply chain back in line, right? What's being imported versus what's made in the USA, and getting all those factories open and staffed. I read a thing this morning that there was a lumber mill that they only had 20 people. They need 30 people, and they'd had to turn down jobs. I think that's part of it. Skilled labor trades, getting more people into that electrician, plumbing, and things like that are going to help that supply issue as well, or that demand issue. So you got the supply chain, which some people think is starting to get better. If you're out there talking, it's still sporadic. Some things have gotten better, cars have not. But as you said, lumber's come down, so there is lumber, but petroleum-based housing challenge. And I think, the Biden administration's got the right idea of what they want to do. It's now executing that plan to get it to where we want to be. And as I said, I think it's much labor related as it is, material related.
Absolutely. Yeah. Very good points. And then again, if we change administrations, it'll take a little while for a lot of this stuff to start having impact. You could get a reversal, depending on what happens in the White House, a little over 2 years from now. So as always, never a dull moment in the mortgage industry, but hearkening back to our pre-live discussion, we've been through a few of these cycles before, and always interesting to see how the market deals with it and how the market, our industry, shakes out at the tail end of a cycle like this.
Yeah, Rich, you and I talk about that. We've got some people that have only been in business, less than 5 years, so they didn't go through the big meltdown and some of the things that we have. And they're going to rely on people, like us that have been around and I won't say help educate, but pick our brain, because we've seen it before. It comes and it goes. It's easy and fun when things are great, but when you have to buckle down, you have to make some tough decisions. You have to stick to your business plan. You have to know what it is, what your business plan is, and watch for the trends that emerge. You mentioned down payment assistance. I think that is going to be a big issue over the next 2 years. People still have the income, but they don't necessarily have the means to get that 3%, 5%, whatever they feel they need to put down on the house. That myth that you need 20, we fight that all the time. You don't need 20%. There are other ways out there. But I think down payment assistance is going to be one of the things that we all need to take a hard look at and see what we can do to help the future home buyers.
It's a great point, because you're right. A lot of people have the labor market strong, but it's that down payment. And at the same time, do you do anything right now to help stoke the demand side of an kind of imbalanced supply demand market? It's just it's interesting, because you have housing leaders in an administration right now that wants to do things to positively impact home ownership and kind of people on the margins, yet there are really some almost for sure unintended consequences of those actions. So It's a balance right now. And that's, I think, what Jim Parrott spoke to last week is like the FHFA, Sandra Thompson, really challenging to balance all that right now.
Yeah, and I think that as lenders, we can have a voice in that and help that move forward. And that's what we need to do.
Very well said. And Ed, always enjoy talking about the mortgage industry with you. We go way back, former banking friendly competitors, and one of our earliest members here at TMC. So appreciate your membership and you always answering the bell. If it's co-host of this show or lead sessions, appreciate you.
Thanks for having me on, Rich. I really appreciate it. And enjoy your collab lab there.
Thank you. And to our attendees, thanks as always for joining us. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. You can also find us on YouTube and where the majority of you consume the show on podcasts. So those of you listening on podcasts, join the live show every Tuesday at 2 p.m. Eastern. If you go to mortgagecollaborative.com and go to our event calendar, you can register for that as well. So until next week, have a great rest of the week, everyone. And thanks again, Ed.
Thank you, Rich. Take care.